Shifting focus back to markets then, and this time US. Now, America's stock market is being run by a shrinking club. The top 10 stocks now account for 43% of the S&P 500's market value, near the highest on record. This percentage has been at or above 40% for the last 12 months. The top 10 companies in S&P 500, Nvidia, Apple, Alphabet, Microsoft, Amazon, Broadcom, Meta, Micron, Tesla, and Eli Lilly, now control roughly 36 to 38% of the index's total value. While that's down from a record high last year, it is still more than double what it was a decade ago, and nowhere close to the 18 to 23% range that held steady from 1990 to 2015. The concentration hasn't just grown, it's outrun profits. Last year, the top 10 stocks made up about 41% of the index's weight, but generated only around 32% of its earnings. In other words, valuation has sprinted ahead of fundamentals, but there are early signs of a rotation. Through early July 2026, the Russell 2000 Small Cap Index returned over 21% year to date. That's comfortably beating the S&P 500's roughly 10% gain. Why does this matter for investors worldwide? Because when 10 stocks move the needle for 500, index funds, the default retirement vehicle for millions, are effectively placing a concentrated bet on AI-linked tech and not a diversified one. Analysts at JP Morgan note that this concentration barely budged even during market pullbacks, meaning that any correction in these giants would hit portfolios harder than history suggests. The question now is this the start of a genuine broadening or just a pause before AI mega caps reassert control? For now, markets are watching small caps for the answer.